Good evening, everyone. I'm Rakhi Gautam from greytHR, the moderator for the session today. Thank you for joining today's webinar on proof of investment submission. Now, before I dive into the topic, let's do a little housekeeping on how the session goes. So, the session is divided in two parts. The first part will be the presentation by our expert, which will then be followed by an audience Q&A. So audience Q&A is where time is all yours. You can start putting across your questions and we will take them up towards the end. Also, this session is currently being recorded. So if you happen to miss out on anything, do not worry at all. We will share the recording of this webinar with you by next week. And the same will also be uploaded on our official greytHR YouTube channel under the playlist Parichay. So you can always, go there and watch it later. So I think we have the quorum to start the session. Uh, okay, let's get started. As I said before, this session will explore the fundamentals of proof of investment submission, common investment types eligible for tax exemptions, and the critical role employers play in facilitating this process. So you will discover best practices to ensure smooth submissions and understand the consequences of non-compliance on taxation. So whether you are an HR professional, an employer, or an employee, this webinar will definitely equip you with the knowledge to navigate the proof of investment submission landscape effectively and optimize on your tax savings. And of course, to decode all of that, we are thrilled to have with us our very own special guest, CA Amaranath AS, co-founder of Arush India. A lot of you are already familiar with his profile. He's been a frequent speaker on our webinar sessions, and all of you always enjoy his session and find it extremely insightful. So thank you so much, Mr. Amaranath, for joining us. I'll just quickly, for those who are unaware, I'll just quickly take you all through his profile. Mr. Amaranath has around 2 decades of experience in the fields of NRI, HNI taxation, US tax, and labor law consulting. He started his career in the International Executive Services Division of KPMG Global Services, where he worked on US tax returns and related compliances for expatriates. Prior to starting his own firm, Amaranath has worked in the global employer services practice in Deloitte, Bangalore. His expertise includes various facets of global mobility, like expatriate tax, social security, PF regulations on international workers, ESOPs, immigration, and assignment structuring, etc. So thank you so much, Mr. Amaranath, for joining us today. There's a lot that we will be learning in this session, and I see a lot of participation already. So I think over to you to take it from here. And as I said, any questions that our audience have, we will take them up towards the end. Over to you.
Thank you, Raki. Thank you for such an introduction. So good evening, everyone. So as the subject is already, fixed for this session, we will be looking into proof of investment submission from employees. As Rocky has already mentioned the agenda, so we will be looking into both employer and employee perspective, and also what exemptions and deductions are available, and practical challenges, what as an employer you may face with respect to this proof of investment submissions, and then also the consequences of non-compliance. So let me just share my presentation. So basically, as I already mentioned, the contents of this session would be the introduction or the exemptions to salaried employees, and also the specified deductions in case of salaried employees, and the impact of non-compliance. So in coming to the introduction, the life cycle of the income tax declarations or proof of investment submission is basically starts with Form 12BB. So most of you may be familiar with Form 12BB, and recently even Form 12B has also been added as an extra form as a part of this income tax declarations. So it's the Form 12BB is a form which captures all the investments and also the tax exemption deductions or the expenses which are eligible for exemptions or deductions it will get captured in this Form 12BB and would be submitted by the employee. Generally, what happens, though as per law, this Form 12BB is a year-end process, As an employer, you need to calculate the tax on the salary on an average basis. So you collect these the investment proofs, I mean the information relating to the income tax, the tax saving investments at the beginning of the year itself. So at the beginning of the year, you will collect. I mean, employees may not be required to provide a solid proof with respect to their investments. It would be more like a declaration at the beginning of the year. And you consider those investments or the deductions and exemptions and arrive at the tax liability on an average basis. And at the year end, again you will collect the originals. But in this process, what I have observed practically is some of the employees will tend to give all the deductions and exemptions which may not be applicable to them, or they may not be incurring that expenditure, or they may not do that investment actually, but still they tend to submit to look at a higher take home. Since the taxes are computed on an estimated basis at the beginning of the year, considering all these investments, their take home salary may go up, I mean the income tax liability may come down, consequently their take home may go up. But at the end of the year, or when the employer asks for the income tax declaration again in the month of December or January, they have to provide the proof along with their submissions, and the investments will substantially come down, which may result in a higher tax liability. So to recover that higher tax liability, employer will have only a couple of months time, so their take home salaries may significantly come down. So just educate your employees not to get into this kind of a practice. One is their take homes or their cash flows are very much impacted. They may enjoy a higher cash flow at the beginning of during the year, but at the end of the year, it will substantially come down. So they may get into a cash flow issues. From an employer perspective also, this should not be encouraged, because I mean, when the tax authorities looks into it, they may say that at the beginning of the year, you have not collected the proof. So, I mean, there is a shortage of TDS. Of course, you would have made it up at the end of the year as an employer, but still, this may raise a red flag to the tax authority. So please educate your employees not to get into these kind of habits. So as at the end of the year, I mean, documentary evidences will be provided. So based on that, actual liability will be calculated, and then the taxes, if there is any shortfall or excess, will be adjusted during the last couple of months. So now let us see what are the exemptions. I mean, there are several exemptions, but I'm going to touch upon the significant exemptions or a common exemptions where every employer would come across. So before getting into the exemption, let's understand the definition of salary as per the Income Tax Act. So salary includes all wages, whether it is paid monthly or fortnightly, which includes basic salary, pension, all allowances like HRA, LTA, special allowance, whatever you call it as an allowance, it's a cash component. So it is a taxable element in the salary structure. Then commission, bonus, benefits like car, accommodation, etc. Any benefits provided in kind, unless there is a specific exemption, that is also taxable. So gifts, termination payments or notice pay periods, then gratuity, leave salary, all this comes under the definition of salary. So generally what is excluded? I do not see any item which is excluded from the definition of salary. So when there is an employer-employee relationship, and if employer is paying something to the employee for, as a remuneration or as a consequential to his services, then it is termed as salary. Of course, certain components are exempt to the extent specified, because limits are there for the exemptions, and also there are several conditions to be satisfied depending on the allowance or the perquisite or the exemption which has been defined. So let us look into those exemptions and deductions now. The first one is the house rent allowance. It's a general common item in any of the salary structures. Is entire HRA is exempt? Definitely no. There are specific rules which defines what is exempt. So the least of the following three criteria is what is exempt from the salary. So one is actual HRA received, then rent paid minus 10% of salary, which is rent paid in excess of 10% of salary, and then the 40% of salary. 50% of salary. Instead of 40%, you should consider 50% in cases of metro cities, that is Delhi, Mumbai, Kolkata, and Chennai. See, Bangalore is a metro, Hyderabad is a metro for us, but for HRA purposes, only these four cities are considered as metro cities, where you could consider 50% of salary as one of the criteria. In all other cases, it has to be only 40%. So what is the definition of salary here? So the salary definition is not the one which we discussed earlier, but for the purpose of HRA, salary is specifically defined to include basic, dearness allowance, and commission. Commission will form part of the salary only if it is paid on a fixed percentage of turnover achieved by the employee, and it excludes all other allowances and perquisites or benefits or whatever you call it as retirement benefits, everything. So what is included is only basic DA and commission, and what is exempt? The three criteria conditions we have seen, and the least of the number which you get out of those three conditions is what is exempt. So there are further conditions attached to it. What are these conditions? The employee should not be living in his own house. So he is living in his own house and he is paying rent to himself, then HRA exemption is not available. Living in a house for which he is not paying any rent, could be a relative's house or brother's house or parent's house, but he is not paying any rent to anyone, then he is not eligible for HRA exemption. If rent paid exceeds rupees 1 lakh for the entire year, PAN of the landlord is mandatory. One practical aspect which I have seen here is employees will tend to provide wrong PAN numbers just to claim the HRA benefit. As an employer, it is your duty to check whether that PAN actually relates to the owner of the property. So you can check this PAN online as under the employer login. If you log in, then you can put the PAN and check the name of the person to whom it relates to. So please ensure that you are checking this, because in case of scrutiny, assessment, TDS assessments and surveys, tax authorities are specifically catching HRA and they are checking whether PAN actually belongs to landlord or not. So as an employer, you should ensure that the PAN provided by the employee is correctly associated with the owner of the property whom he is referring to. Then rent should have been paid for the house where employee is living. The first two criteria also I mentioned. So if he is living in any house where he is not paying rent, then he is not eligible for HRA exemption. And entire rental payment is also not deductible from income. So what is deductible is the least of the above three parameters. So let us see practical issues in this HRA. One, we discussed about the landlord PAN. The other things are the employee has not submitted these lease agreement or rental receipts, anything to the employer, and the due date for submission of the proof of investments is already closed by the employee. In the month of March, employee comes and says that I have rent receipts, I have lease agreement, for some reason I could not submit to the employer. So what is the solution available to the employee in this case? However, as an employer, I'm not asking you to open up the proof of investment submission again and consider those. However, the choice available to the employee, the option available to the employee is to claim it on the tax return. HRA is a very well or very much allowed exemption which comes under Section 10. There is no hard and fast rule that it has to be claimed through only through employer. As an employee, you can claim it on the tax return as well. However, ensure that all the documentation, whether it's a rent receipts or lease agreement, everything has been properly maintained, and the proof of rental payment, receipts for rent payments, everything is maintained by the employee. Then he can very well go ahead and claim this exemption on the tax return if he is missed to submit his proof to the employer. So another thing here is, whether all employees can claim? Yes, all employees can claim, provided he has a HRA component in his salary structure. If his salary structure itself is like that, where HRA component is not part of his salary structure, then he is not eligible to claim HRA, even though he is paying rent and maintaining documents, there is a lease agreement, everything. So the very important criteria is to ensure that you have a you have HRA component in your salary structure if you are claiming it on the tax return. Then the next question is, can HRA be claimed by an employee who is having his own house, which is vacant, but living in a rented accommodation? See, these are one criteria where he is living in his own house and he is not paying any rent. But here that is not the scenario. He has his own house, but that is vacant owing to the purposes of employment, because he is staying far away. His own house may be around 20 kilometers or 25 kilometers away from his workplace. So it is not possible for him to commute daily So he is living in a house which is very near to his workplace and he is paying rent on that. So can he claim HRA? He is already owning a house. Yes, he can claim HRA benefit because the condition for claiming the HRA, it says he should be paying a rent for the house where he is living in. It does not say that if you have a house already, then you cannot claim it. So he can very well claim the HRA benefit as well. However, as an employer, I would suggest that take a declaration from the employee that though he has a own house, it is kept vacant and owing to purpose of employment only, he is living near to the workplace. So that is why he is he is paying the rent and he is eligible to claim HRA benefit. The other question where I get from employers is there any number of kilometers or miles defined anywhere? So there is no definition or the rules or the act or salary circular for that matter does not define any distance specifications. So, I mean, it is some companies have defined this as a part of their policy structure, so the payroll policy that employee should have a minimum 30 kilometers distance or 20 kilometers distance. However, actually speaking, the rules does not provide any such distance criteria. How, of course, it should be reasonably at least far off. I mean, it cannot happen that he's just 1 or 2 kilometers away and he is showing a rent receipt saying that I'm living in a house where I'm paying the rent. So that should not happen. Just ensure at least the reasonable distance is there between the home which is vacant and all the workplace. Then other practical aspects is can HRA be exempted in the following scenarios? First scenario is rent paid to parents or in-laws. They are very much relatives for the employee and whether this can be claimed. See, rent paid to parents and in-laws can be claimed provided there is an actual payment of rent from the employee to their parents or in-laws. And also there are receipts, lease agreement is there, and employees providing PAN of their parents or in-laws to whom he is paying. If all these conditions are satisfied, yes, it can be claimed as an exemption. Rent paid to spouse. See, rent paid to spouse, also there is no restriction in the rules or the laws. However, in various forums, when this question has come up, tax authorities are saying that if it is paid to spouse, somehow we are not trusting that arrangement. So that arrangement is not practically acceptable. So we cannot claim, we cannot grant the HRA exemption if it is paid to spouse. So, I mean, this is what the opinion coming from the tax authorities itself. So, if the rent is paid to the spouse, then a caution need to be exercised by the employer whether to grant this exemption or not. Then rent paid to any other relative. So any other relative is also fine provided the rent paid is a fair rent. It should not be a hyped up rent or a more rent than the fair market value. So if those conditions are satisfied, then the exemption can be claimed. And another measure is the rent paid to a relative. This is more for an employee to look into. So if it is paid to a relative, ensure that the income is declared in the tax return of the rent receiver, that is the relative. So in that way, if there is any question, we can substantiate. So as a payroll person or an employer, you may ask, how would the tax authorities will get to know? Or as an employer, how do I know whether it is paid to parents or spouse or to a relative? Of course, I know there is no way that as an employer, you would be knowing that. But these are the precautions for an employee to take care. I mean, if he is getting into these kind of rental payments, so he should have adequate documentation so that tomorrow if a notice comes, then it can be easily substantiated. Then comes leave travel allowance, LTA. So what is LTA exemption? It's basically the deduction or the exemption provided for the travel made to your native or to any other place within India. It is allowed to be claimed twice in a block of 4 calendar years. So what is the exemption available? Exemption is available if the journey is by air, economy class fare of the national carrier, that is Air India. Then if the journey by rail, maximum is AC first class or the amount spent, whichever is less. And other public, if the place is not connected by rail or air, then the other public transport is not defined in the act. So it can be any mode of transport on the road. So the amount spent for the journey is what is exempted. Very important points to note here is only domestic travel is covered, not international travel. So if it is by air, please ensure that when he is providing the proof or the air bill, please ensure that the travel he has made within India only and not abroad. Another thing to take care in the air travel is there is a tendency for the employees, they just go and book and they take the tickets, print out, and the next moment they go and cancel it. So as an employer, one precaution which you can take care here is to collect the boarding pass as well. Many companies are insisting for boarding pass as well if the travel is by air. So that is an authentic proof that actually the journey has taken place. And only traveling is considered. Lodging, boarding, food expenses, those things are not considered as part of the LTA exemption. Then the 4-year block which I mentioned, the current block is from 2022 to 2025. So then the next question is, sometimes employees will come back saying that in the last block, I have not availed all the all the 2 journeys, both the journeys. So I have availed only one or I have not availed at all. So what happens to my journeys which I am not availed? So the law provides that in that case, as an employee, he can carry forward one such journey to the next block, but that should be availed in the first year of the block. So in the current block 2022 to 2025, an employee who has availed only one journey in 22 to 2025, he can claim one more in 2026. So in 2026 to 2029 block period, he can have 3 journeys and 3 exemptions during that block period. Yeah, then comes, what benefits of the exemptions can be claimed in the tax return if it is not routed through employer, if it is being missed to routed through employer, through payroll. So HRA we discussed, and yes, it can be very well claimed in the tax return. LTA depends. I mean, of course, there is no hard and fast rule for LTA as well, which says that it has to be routed through employer only. So LTA also can be claimed in the tax return. Leave salary. Of course, leave salary is not a part of the today's discussion. There is no proof of investment or declaration involved here. It is an employer calculation at the time of exit, which would be done by the employer himself and make the payout. So leave salary, if employer is not granting the exemption, then whether it can be availed in the tax return, yes, that can be availed in the tax return. Based on the judicial precedents, it can be leave salary is exempt even if it is paid at the time of resignation, though it is not a retirement. Then NPS contribution, life insurance, medical insurance, housing loan interest repayment, housing loan principal repayment, all these can be claimed in the tax return, even though it is not routed through the employer. Reimbursements through payroll. See, when I say reimbursements, generally what we see is could be telephone reimbursement, internet expense reimbursement, vehicle expense reimbursements. These cannot be claimed in the tax return. So these have to be routed through employer only. So please ensure that if these things are part of your salary structure and payroll, then ensure that you are submitting the proof to the employer within the due date so that employer will incorporate these exemptions and deductions in the Form 16. Then comes the income from house property. So house property includes rental income from house property. So 2 kinds of properties. One is self-occupied property and let-out property. Self-occupied property is nothing but basically the employee himself is staying there, and the let-out property is basically let out and where it is generating rental income to the employee. So I have just given a small snapshot how the computation has to be done under the income from house property. So it is rental income in case of let out property. In the case of a self-occupied property, it is nil. So there is no deduction for municipal taxes in case of self-occupied property. However, in the case of let out property, actual on payment basis, the municipal taxes are allowed as deduction. Then 30% of the net annual value, which is for repairs and maintenance. There is no need to maintain any supporting documents or anything. This 30% is a straight deduction or a standard deduction, even if the employee has not incurred any expenses towards repairs and maintenance, this 30% deduction can be provided. Then comes the housing loan interest. Housing loan, this 30% deduction for repairs and maintenance is not available in case of self-occupied property. It's available only in case of let-out property. Then housing loan interest, in case of self-occupied property, up to 2 lakhs is what is allowed as deduction. In case of let-out property, the actual amount of interest payment without any limit is allowed as deduction. Then whatever comes after deducting these things is the net income from the house property. So house property loss up to 2 lakhs can be offset with any other income through the employer or in the tax return. So balance loss has to be carried forward for 8 years. Say suppose under the, of course, under the self-occupied property, the maximum deduction allowed itself is 2 lakhs. So that 2 lakhs you can offset with salary income or any other income. However, in case of let out property, say the actual interest payment is much higher and you have a loss under that LOP calculation, you did the calculation and there is a 5 lakhs loss. Even in that case, only 2 lakhs is allowed to be offset with other income. The balance 3 lakhs you have to carry forward for a period of 8 years. Then income from house property, self-occupied property means what? What and all properties it includes? The house which is in the occupation of the owner, which is self-occupied. House which cannot be occupied by the owner owing to his employment at a different place. We already saw this under the salary section as well. I said that, yes, if he is paying rent to another property where he is unable to occupy his own residence owing to the purpose of employment, that can be allowed as a HRA exemption can be allowed. So in this case, even the interest can be reduced. So the taxpayer or the individual employee can have two benefits. One is the interest payment, which is 2 lakhs deduction. Then on the HRA exemption, if he is actually paying rent in this case. So, and then the next thing is like employee is having more than 2 houses for self-occupied. Maybe one he might be living in, the other maybe his parents are living in, and the other one he has kept as a vacant. So he has 3 properties. In that case, 2 properties has to be considered as self-occupied. The third one has to be treated as let-out property. And these 2 houses he can select at the option of the assessee. The 2 can be considered as self-occupied. Other property has to be considered as deemed let-out and offer for taxation. So interest deduction will be allowed as follows. There are limits for the interest deduction as well. If the purpose of borrowing is repair or renewal or reconstruction of the house, and any time the borrowing might have happened, the maximum deduction allowed is only 30,000. So it is not a construction of the house, it is repairs and renewal of the existing house. The maximum deduction allowed is only 30,000. If the purpose of borrowing is for acquisition or construction of a new house, then if the date of borrowing is prior to 1st April 1999, again it is 30,000 only the deduction. Of course, this is outdated 25 years back. If the person has borrowed the money, then it is 30,000. Practically, we may not come across with this situation. So mostly the employees may fall under the third category, where the acquisition or construction of the house has happened and also the date of borrowing is after 1st April 1999 and the maximum deduction allowed is 2 lakh. And one more condition is the construction should have been completed within 5 years of time. And for the house property, there's a first-time home buyer option under section 80EE or 80EEA. Additional deduction is allowed. This deduction, this interest is in addition to 2 lakh rupees, and this comes as a deduction under 80EE or 80EEA, which is chapter 6A deduction. It is not under the house property. Of course, on the total income, it is allowed as a deduction. So then again, there are stringent criteria for this as well. So what is the criteria under section 80EE? Property value should be less than 50 lakhs or up to 50 lakhs, not more than 50 lakhs. So loan amount should not be more than 35 lakhs, and the loan period covered. Loan should have been borrowed between 1st April 2016 to March 31st, 2017. So maximum rebate allowable is 50,000 only. If an employee has declared anything here, you need to ensure all these things: the value of the property, loan amount, and also importantly the loan sanction period, period. So this thing may not be available in the housing loan certificate which the employee may provide. So you need to specifically ask him for a sanction letter of the housing loan, and then see whether he is eligible for this deduction or not. Then section 80EEA, up to rupees 45 lakhs, there is no limit on the loan amount. Loan period covered is April 1st, 2019 to March 31st, 2021, 2 years time. The maximum rebate allowed is 1,50,000. So income from house property, again, certain practical aspects. When the home or the house is owned jointly by both husband and wife, also the loan is also a joint loan. So what happens? The scenarios, both are repaying the interest equally. Both have income sources and both are repaying the loan equally. So each of them can claim rupees 2 lakhs in the case of a self-occupied property. So in case of let-out property, both have to claim 50% of the interest paid in each of their returns. And only one of them are repaying the interest. Sometimes the bankers will insist for the joint loan, or a co-applicant will mandatorily should be there. So the employee has gone for a joint loan, but only he is repaying the interest, entire interest. The person repaying the interest only can claim up to 2 lakhs. The other spouse cannot be able, would not be able to claim any deduction. So even in the case of let out property, it is same. Only the person who is repaying the interest can claim. So both are repaying the interest, but not equally, in unequal ratios. Maybe 30% by spouse and 70% by employee. In that case, each can claim proportion to their repayments. However, each of their shares should be limited to 2 lakhs. Say, for example, there is a 5 lakhs of loan. 30% is paid by wife and 70% by husband. So in that case, 1,50,000 and 3,50,000 is what we get as each person's share. So the wife can claim 1 lakh, entire 1,50,000 as deduction because this is less than 2 lakhs. But husband can claim only 2 lakhs and the balance 1,50,000, he has to forego the deduction. And in case of let out property also, each of them can claim proportionate to their repayments. So now we will move on to certain deductions. Okay. The deductions applicable in the case of individuals, of course, section 80C. Deduction 80C is a huge basket of tax saving investments. So, I mean, the list goes on. However, I have tried to give you an example which we commonly come across. So the payments covered are life insurance premium, contribution to provident fund, which is employee contribution to provident fund, ULITs, pension funds, tuition fee in case of kids, and housing loan principal repayment. Then contribution to NPS, employee contribution to NPS is also covered here. Of course, NPS has additional deductions as well, which I cover in the next slides. So here also, ATC also covers NPS, employee contribution. However, though the list of the items which can come under is a huge, but the total deduction is available only to the extent of 1,50,000. It is capped at 1,50,000. So even if your investments under this section is crossing 1,50,000, employee is eligible only for 1,50,000. Then 80TTA and 80TTB. 80TTA is for normal employees who are not senior citizens, and savings account interest for a maximum of 10,000 rupees is allowed as a deduction. 80TTB in case of senior citizens, it is interest on deposit, including whether it is savings, recurring deposit or fixed deposit. All deposit kinds of deposits are covered, and the maximum deduction allowed is rupees 50,000. So then comes 80D. 80D is also an important section because though it is relating to the medical insurance, there are certain other expenses are also covered here. And let us see what are those expenses covered here. One is, of course, the medical insurance, or generally call it as health insurance premium. In the case of individual and his family, 25,000 rupees is allowed as a deduction, which is if the actual premium payment is more than 25,000, it is restricted to 25,000, or otherwise the 100% is allowed. And if the individual himself is a senior citizen, then this deduction will go up to 50,000 rupees. So maximum deduction for parents is also 25,000. However, if your parents are senior citizens, then it is additional deduction of 50,000 is eligible. So in case of employee and his family, assuming he is not a senior citizen, it's 25,000. And in case of his parents, assuming the parents are senior citizens, then maximum deduction is 50,000 rupees. This also covers preventive health checkup to the extent of rupees 5,000. But this 5,000 is not an additional deduction. It is already covered under the 25,000 and 50,000. So just to take an example, in the case of an individual, if he is paying 18,000 as his medical insurance premium, and if he has incurred 5,000 towards the preventive health checkup, then the total deduction would be 23,000 in his case. And there is an additional proviso which says that in case of senior citizens, if the medical expenses are incurred in case of senior citizens who are not covered under any medical insurance, then there is a deduction available up to rupees 50,000. So this is very important that there has to be no medical insurance for them. Only in that case, the medical expenses to the extent of 50,000 is allowed as deduction. So there is no hospitalization required, like 24 hours has to be hospitalized or 2 days need to be in hospital. There is no such conditions. Even the general expenses, medical expenses for their treatments or checkups on their medicines is covered here. However, as an employer, you should collect the receipts for this. Then only I'll advise you to provide this deduction. So then comes the 80G for donations. Donation made to specified organizations or funds, which is recognized under section 80G. If you are making the donation to a private organization or a charitable institution, they will provide a receipt, ensure that that receipt has PAN, and also they mention the circular and the recognition when they have obtained this 80G recognition. Only those donations are allowed as deduction. So donation in excess of 2,000 rupees should be paid through non-cash modes only, so through banking channels only. So this is generally not considered in Form 16. As an employer, he may not be in a position to look into all that aspects. And also in donations, there are different types of donations which qualifies for 50%, 100%. So employer may not be in a position to verify all this. So this is not a general practice to collect donation receipts from the employees and consider that in Form 16. So employee can claim this in the tax return directly. Yeah, now comes NPS, which is National Pension System. Very interesting topic. So here, first is there are two types of funds in NPS. One is Tier 1 and Tier 2. So any contributions to Tier 1 alone qualifies for tax deduction, and contributions made to Tier 2 accounts does not qualify for any tax benefits. So when the employee provides his NPS statement, the employer has to verify whether the contribution has made to Tier 1 account or Tier 2 account. So only Tier 1 account eligible for tax deduction. Again, there are two contributions, employee contribution and employer contribution. If NPS is part of your salary structure and you have opted for corporate NPS, then the contribution is an employer contribution. That goes as an employer contribution. So coming to 80CCD1, which says that up to 1.5 lakh is eligible for deduction, and under this 80CCD1 is part of ATC limit of 1.5 lakhs. So whatever the employee contribution has gone, first it goes to ATC and sits there, and it qualifies for one of the tax saving investment under ATC. However, there is another section 80CCD1B. This is in addition to ATC of 1,50,000, and the maximum deduction available under 80CCD1B is 50,000. So I'll just give you an example how this works. An employee has made NPS contribution, employee contribution of rupees 75,000 during the year, and his tuition fees and contribution to PF, PPF all together is coming to 1,25,000. So what happens to this 75,000? So first it goes and sits in 1,50,000 basket ATC. So his total deduction will be 2 lakhs there. Of course, ATC will be restricting its total deduction limit is 1.5 lakhs. So the balance 50 lakhs of NPS contribution is still available for him. That 50,000 again he can come and claim under 80CCD 1B. So he can avail the total benefit of 2 lakhs deduction, and this additional deduction of 50,000 is available only for NPS deduction. If there is any excess the payments like tuition fee or insurance premium or PPF, that won't fall under this. This is specifically provided for NPS contributions only. Then comes 80CCD2. 80CCD2 covers employer's contribution. So employer's contribution is available as a deduction up to a maximum of 10% of the basic and DA. And this 10% has been increased to 14% for the financial year 24-25 only under the new regime, not for old regime. So, then deduction towards employee contributions, which we discussed under ATC and ATCCD 1B, both are available only under the old regime. Under the new regime, they are not available. So the total employer contribution to PF, NPS and superannuation, if it together exceeds 7,50,000, the excess of such contributions is taxable as a perquisite in the hands of the employee, and the employer has to capture that under Form 12BA. So deduction is available, I already mentioned, only for the Tier 1 account. Then comes another deduction, which is ATDD or ATU, maintenance of a person with disability. So then there are conditions to it. The individual has to be a resident. Individual in the sense the person who is claiming this deduction has to be a resident India or HUF. The expenditure incurred for the medical treatment, training or rehabilitation of that relative or a dependent can be claimed only when deposited or paid to an approved LIC or UTI scheme for the maintenance of such relative. The fixed deduction is 75,000. Higher deduction is of 1,25,000 is also available if the severity of the disability is higher. And one important thing to keep in mind is from last year, it is the Form 10IA has been introduced. This Form 10IA has to be filed before filing the return in case you are availing this ATDD or ATU deduction. As an employer, there is 10IA may not be available. However, it is advisable to insist to get Form 10IA as a part of the payroll submission if the employee is claiming deductions under ATDD or ATU. And the dependent is defined to include spouse, children, parents, brothers and sisters who is wholly and mainly dependent upon the individual. Then comes the medical treatment for specified diseases. This is not disability. If the dependents or the employee himself, if he is suffering from specified diseases, then he can claim deduction under Section 80DDB. The maximum deduction is 40,000. However, in case of senior citizens and very senior citizens, it's been revised to 1 lakh rupees. So then from 1617 onwards, taxpayer is required to obtain a prescription from the specialist doctor who certifies that there is a specified, he is suffering from that specified disease, and he will mention certain particulars which are required as per the rules, and then only the employee can claim this deduction. So as an employer, please ask for the doctor's certificate here and then provide this deduction. Then comes ATE, educational loans. So if the loan is taken by an individual for study in India or outside India, this is even foreign education is covered here. So then they can claim deduction. So what is the deduction amount? There is no specific limit for the deduction amount, but only the interest repayment is allowed as a deduction. And in case of, it could be education for self or spouse or children or any student where the individual is a legal guardian. And the deduction is available for 7 years subsequent to the year where he has started repaying the interest until the interest is fully paid, whichever is earlier. Yeah, new regime, everyone knows. Let us see what are the deductions or exemptions not available under the new regime. So most of the deductions or exemptions are not available. The standard deduction or profession tax, interest on housing loan, what we discussed for the self-occupied property, that 2 lakh rupees is not available. So major deductions under Chapter 6A, that is ATC, ATCCD 1, ATCCD 1B. So all these deductions, ATG donations, Nothing in Chapter 6A is available. 80D is also not available. So these deductions are not available in the case of old regime. So can we say that if the employee has opted for old regime, then this proof of investment submission is not applicable to him, or there is no need to look at that. So we can just go away straight away without considering any of the submissions. We can just go and process the payroll. It depends. Like there are certain deductions available even under the new regime. See, where the proof of investment comes into picture, I have highlighted those deduction. It is a motor car benefit and the related vehicle expenses reimbursement. If employer has that, this is available under the new regime as well. Then gadget benefits are available under the new regime. Telephone expenses reimbursement or internet expenses reimbursements, these are available under the new regime as well. So if you have these benefits in your payroll, even if the employee has opted for new regime, you need to verify whether he has provided proof for with respect to these deductions or these expenses, and accordingly consider them for the payroll processing. So yeah, as I already mentioned, there are latest amendments with respect to Form 12B-AA. So what is the objective of 12B-AA? See, 12B-AA was introduced during in the Finance Act 2024, that is Second Finance Act 2024, and the whole objective is to ensure that the employee is not out of pocket, or he is not facing a cash flow issue only because he has TDS or TCS on other income. So what used to happen is, if there is a TDS on the interest income, or if there is a TCS element where the taxes has been paid by the employee, there was no provision for the employer to consider them and then adjust the tax liability on the salary income. So there was a hardship to the employee. He was mandatorily, he has to file the tax return and then claim this as a refund and then wait for the refund to come in. Return filing is okay, but waiting for the refund is what was a pain point prior to this, till last year. So return filing may happen in June, July, and by the time he receives the refund could be July or September. So there was almost 6 months gap by the time of incurring this expense and getting the refund back. So in order to curb this cash flow issue, the government has introduced Form 12B-AA. So what are the particulars in this section? It is applicable for both TDS and TCS. TDS is nothing but tax deduction at source on other income, that is other than salary income. If you have any TDS, you can go ahead and declare that income as well as that TDS done on that income. So employer has to consider both income and such deduction of taxes, and then claim then compute the tax on the salary income. TCS is nothing but tax collection at source. TCS is applicable in case of foreign remittances or foreign travel or foreign tours. Then under LRS, if the money is sent to any relative or dependent for to take care of his personal expenses or tuition fee, then TCS is applicable. So similar way, you can declare that TCS amount to the employer and then ask him to consider this in the tax liability computation. But there are practical challenges to it. It is not that straightforward because government has not notified that what is the complete procedure with respect to this. That may come in the salary circular, but salary circular has not yet come. So yeah, if the employee is providing Form 12B-AA, I advise employers to collect the supporting documents as well. It could be 26 AS where this TDS amount is reflected or TCS amount is reflected, or is there any communication by the service provider that the taxes have been deducted or collected at source. So consider something as a proof and then allow this deduction. So finally comes to the non-compliance. So what is non-compliance here? Basically, non-compliance refers to considering not looking at the investment proof properly, and where those are fake proof has been submitted, and by oversight, the employer has considered that and allowed the exemption, or proof has not been submitted, but still employer has provided those exemptions. These are results in a non-compliance. The tax authorities in TDS surveys will look into all these things. They recompute the taxes, and if there is any shortfall in the TDS, they ask the employer to bear that cost. So the interest, one is on the tax part. The other one is interest is applicable at the rate of 1% per month in such scenario. Then penalties may go up to 100%. There is also imprisonment, or what we call it as prosecution, also can be triggered to the management of the company. So it is employer's duty to ensure that these proofs have been collected, verified properly, and then only the exemption or deduction is allowed to the employee. Yeah, that's all for today's thing. So let us see if there are any questions.
Thank you so much for that very comprehensive presentation, Mr. Amarnath. We covered a lot of points. And I understand, because for me also it was a lot. So, for all those who are there, don't worry at all. This webinar recording will be shared with you. And I see some comments asking for the PPT. So, you'll be able to access the webinar, and there you can, see all the details which were shared. So, yes, thank you so much. And thank you once again for the
Thank you.
presentation. Let's quickly dive into the questions because we have some limited time. I'll quickly
Yeah.
take. So, the first question is, of course, some of these questions might have been already covered in the presentation, but we will just quickly skim through these. So, the first question is from Rahul. If both an employee and their spouse work for the same company, can they each claim 100%, or should they split it 50% each?
So I think this question is related to the housing loan
Yes.
interest on the self-occupied property. So yeah, each of them can claim 2 lakhs if their contribution to the housing loan interest is more than 2 lakhs. So if you want to allow them to claim 2 lakhs each, then the interest payment should have been more than 4 lakhs.
Okay. Thank you for that. Next question is from Venkat. PG rent can be claimed as HRA or not?
Yes, it can be claimed. PG rent is also an accommodation basically. However, ensure that they have the proper supporting documents.
Okay. Next question is whether NPS investment can be claimed by an employee in a new tax regime.
Yeah, I covered this. So there are two types. One is employer contribution and employee contribution. Employee contribution is not allowed as a deduction under new tax regime. Only employer contribution is allowed as a deduction under new tax regime.
Okay. Next question is, in salary structure, if there is no LTA component, can still claim for LTA?
No, they cannot claim.
Next question is Sushmita asking for the PPT. So as I said, we will share the recording and you'll have access for that. Next question is from payroll username. So PAN and Aadhaar were not linked. So we have default in Q4 for last financial year. If we delete those two employees, okay. I think the question is incomplete, or I'll still read out. If we delete these two employees from all quarters in last financial year, then is it possible to remove that default?
No, this is more of a practical question. So if you've already declared and if they are your employees, I don't think you can go ahead and delete. So you have to collect the correct information and then file the revised TDS returns.
Next question is, interest on let out property is applicable under the new tax regime or not? And
Interest on let out property is applicable. Yes, let out property, there is no new tax regime or old tax regime. So interest should be allowed as a deduction under new tax regime as well or old tax regime as well. And 80EE and 80EEA allowed only if 24B exceeds. Generally, yes. Otherwise, I will come to 24 and claim the deduction because 24 I can offset with other income, but that if it is under 80EE or 80EEA, the offset option may not be available. So it is always first you claim under 24B, and if there is any excess interest and if the employee is qualifying for EE and EEA deductions, then you provide them under the Chapter 6A deduction.
okay. There's another follow-up to
Yeah,
that.
80, is it required to take full-time course? Yes, it has to be an studies only. It is not a certificate course. Certificate course or a hobby, those things will not qualify because the rules say that the education should be by a recognized university or a college.
Okay. Next question is from Govardhan. Under Section 80D, senior citizen, if medical bill payment is 5 lakh and we receive 4.5 from insurance and balance 50,000, can we get exemption on this?
See, the 50,000 medical expenses, I clearly mentioned that is available only if they are not covered under the insurance. If you are receiving 4.5 lakhs from the insurance company, that means it says that they are covered under the insurance, so they are not eligible for the 50,000 deduction.
Okay. There's another question from Govardhan. Under new tax regime, employer PF will get tax exemption or not?
Employer PF, yeah, PF Provident Fund is of course exempted under the new regime as well. Employer contribution to Provident Fund, yes.
Next question is from Santosh PM. Question is on the employee who joins in between the financial year. In the previous company, employees' income tax is calculated and tax is remitted under old tax regime. And in the present company, can he opt for new tax regime? If yes, then what should be the taxable income to be considered for income tax calculation, whether it is in the income after considering Section 10 exemption or gross income?
Okay. So interesting question. So if in the present company, yes, he can very well opt for the new tax regime. There is no hard and fast rule that if he had already opted for the old tax regime in the earlier organization, he has to continue with that. That kind of a rule is not there. So if he goes for the new tax regime, then you should not consider any exemptions or deductions which are available under the old regime, even though that has been considered by the previous company. So you have to calculate as per the new regime only. Only the qualifying exemptions or deductions under the new regime alone should be allowed. Also consider the previous employer's income can be considered, but not the exemptions and deductions which are not available under the new regime.
Next question is from Govardhan. Will a gift and meal card will get tax exemption under the new tax regime?
Yeah, gift will qualify for an exemption under the new regime, but not the meal card. Meal cards are taxable under the new regime.
Next question is from Nitish Kumar Mishra. What is the good time to open window for proof of investment?
This depends on the company policy and the number of employees as well. So companies generally open up during December and they give time till 15th January, so that January payroll, they will have at least 2-3 months payroll to consider on this. Yeah, I think it is December or Jan would be a right window to roll out POI.
Okay. Next question is from Venuji asking for the recording. Yes, we will share the recording with you all. Then there's another question. So this is from Sumit. At the time of proof of investment submission, can an employee still change their tax regime?
See, as per the circular and the guidance provided by the income tax authorities, if employee has opted for the regime at the beginning of the year or when it has been asked by the employer, he has to stick to that and he cannot claim that regime. However, he is free to change the regime at the time of filing the tax return. But practically, I have seen many companies or employers providing that option to change the tax regime. Though there is no, implication as such, if you just want to follow the circular, it is advisable not to provide that option to the employee.
Okay. Next question is from Priya Vikram Singh. Is there any provision for donations to political parties? If so, what is the employer's role in this?
Any donations, employer role will be almost nil because employer is not considering that as part of the proof of investment submission or the deduction purposes. So, any donation for that matter, the employer's role will be zero.
Okay. Next question is from Deepa. LTA can be claimed block of 4 years twice. Suppose if employee joins our organization in mid of the financial year in the same block, how should we go back and check if he already availed the LTA benefit?
Yeah, good question. So you will not be able to check this aspect. So as an employer, I would suggest that you take a declaration from the employee to the effect that whether he has already availed or not availed, whatever, and keep it for your record purposes. Based on the declaration, you can go ahead and provide that exemption.
Okay. Next question is from Anjana. If employees are paying 10K as a rent, however, they are providing the rent receipts as 20K or 15K, And also they provide PAN card of their landlord. In such cases, what should we do? Should we consider?
Now, first of all, how do you know that they are paying only
Yeah.
rent 10,000 as a rent is my question. So if you really know that they are paying 10,000 as rent, then you should restrict it to 10,000 only. You should not give 20 or 15,000.
Right. Next question is from Karthik P. If it is same city, can we claim HRA and home loan interest?
Yeah, as I said, even within the same city, it can be claimed, but provided the distance also need to be looked into. If the employee, owing to purposes of employment, if he is not able to stay in his own home, then you can provide HRA and also the home loan interest benefit.
Next question is from Anand Sharda. Can we collect proof of investment in soft copy or hard copy is required?
No, soft copy is also fine. There is no mandate to collect a hard copy.
There's another question. What is the ATD deduction if the single health insurance covered both self and parent?
No, then parents are considered as they're covered under the insurance. So additional 50,000 deduction for medical expenses is not available. However, for deduction purposes, both together should not exceed 75,000. So you can provide the insurance coverage benefit up to 75,000, provided the parents are senior citizens.
Okay. Next question is from Prabhakaran. If I and my wife live in different locations due to my work nature and kids study, can I claim 2 HRA?
Yes, I'm assuming that both of you are paying the rent because you are living in two different locations. Yes, both of you can claim HRA benefit.
Okay. There is a feedback from Hiril. Thank you for nicely explained session on proof of investment.
Thank you.
Thanks.
Thank you.
Thank you. Moving on. This question is from Dipti. For education loan, only individual can take or on behalf of spouse, son or daughter can be applicable for exemptions.
Generally, the loan itself is granted to the earning member of the family. Either it could be the parent, one of the parents, or both the parents as a joint loan. And son and daughter, I'm assuming because they are they are going for the education loan. Obviously, they will not be earning anything. So whether it is for the self, spouse, or son and daughter, the exemption, the deduction is available.
Okay. Next question is from Bibin. Is there any exemption on convenience allowance?
Conveyance allowance exemption was there quite some time back. So now there is no exemption available. Even under the old regime, conveyance allowance exemption is not there.
Okay. I think some questions we did cover. Can room sharing under rental agreement be claimed under HRA?
Yeah, if there is a proof that it is being shared and only 50% of the rent is being claimed by the employee, yes, it can be claimed.
Okay. As part of new regime, no tax to be deducted at source if salaried income is below 7.5 lakhs. However, payroll shows TDS of 3,000 change for annual CTC of 7.32 lakhs.
Okay, as part of new regime, no tax to be deducted at 7. However, payroll shows TDS of 3,000 change for annual CTC of 7.32 lakhs. So I presume that maybe by mistake this has already been deducted and remitted to the government. In that case, the Form 16 will anyway show this 3,000 as a refund, and the employee has to file the tax return and then claim this refund back.
Okay. Next question I'll take from Hiril. For NPS, whether any process to be followed by the company to adopt and make it part of CTC and how? Kindly explain.
Yeah, there is, because it is a corporate NPS structure, there's a separate process to be followed. I think you can connect to any of the POPs. POPs are points of presence for the purpose of NPS, and generally all bankers are POPs like Kotak, ICICI, Axis, even LIC has, I think. So you can get in touch with any of these people, and they will explain how the corporate structure works, and there's a separate process involved in that, so that they would be able to take care of it. Or you can drop me an email. I'll also pass on the connect, which I have, the POP connect.
Sure. Next question is from Devi. Can we give exemption under 80D if medical bill of senior citizens are paid in cash?
No, the cash payment is not allowed as a deduction. It has to be non-cash payment only.
Okay, moving on. This is from Akshay. If an employee is exiting before the date of submission of proof of investment, that is before December 2024. Okay, just a moment. It got skipped. Usually, POI is collected in the month of Jan or Feb. Then, what should be the employer's responsibility or general practice?
Yeah. So this is also a good question. So in that case, as part of full and final settlement itself, all the proofs need to be collected. Though POI is not rolled out across the company, only for that employee he has to submit all the proofs. As I mentioned at the beginning of the year itself, he would have declared his investments. So based on that, you have to collect all the supporting and then only make the full and final settlement.
Okay. This question is from Dura Raj. If the employee gets salary hike on in the middle of the month, like September, based on his salary hike, is he eligible for TDS? Shall we release POI for upcoming payroll? An employee also can submit. Is this possible?
Yes, that is possible. So if there is any increments have happened during the year, maybe you can roll out the POI during the month where the increments have been implemented, or you can just wait for the year end and you can roll out the at the year end as well.
Okay. Next question. This is from Sushmita. Are there any tax implication for employees who receive benefits like ESOPs as part of their compensation package?
There is no specific tax benefit as such, but there is a computation mechanism for ESOPs. So perquisite has to be calculated according to the rules and considered in your Form 12B. That's it. There's no specific exemption available.
Okay. This question is from Meghanathan. ATE, private loan is eligible for deduction or only if any authorized by RBI?
ATE loan, yeah, it has to be authorized by RBI. Yeah, it is approved financial institutions or scheduled banks are eligible for only the loans by these authorities are eligible for deduction.
Next question is from Rohit. We have received TDS demand for short deduction due to one of the employee has not linked his PAN with Aadhaar and linked the same on last date, that is 31st May 24. What should I do to clear the demand?
No, 31st May was the last date. I think now again you need to, refile the TDS return and then the default should go away.
Okay. When doing proof of investment, Section 80 TTA was considered even if income on savings was not submitted. Please confirm if this is rectified around this time. Is
No, if
this
the interest amount is not declared by the employee, then you cannot give the ATTTA deduction.
okay? This question is from Sharon. Rental agreements are mandatory for HRA or not?
That depends on the company policy. The salary circular does not talk about a rental agreement or a rent receipt, but as an employer, how will you evaluate the rent payments? There has to be some documents. So either of those two or both should be asked for as an employer. I mean, I would personally advise that rental agreement should be in place, not the rent receipts alone.
Okay. There's one feedback from Poonam, which is okay. So many questions. Okay. Thank you for your time and all the inputs. This session is pretty useful.
Thank you, Poonam.
Okay, let's take a last couple of questions because we are already, running out of time. We have surpassed the time. But yes, for those, as we always say, this recording will be shared with you. So you can always go back, watch it later, revisit. And we will also be sharing Mr. Amarnath's email ID with all of you. So you can personally connect with him and, have one-on-one discussions if that is required. Okay, let's. So this question is from Sarita. If I'm paying rent for myself in Bangalore city and for my parents in Delhi, how can I claim both?
No, you will not be eligible to claim both, because the section specifically says that it is for the employee. I mean, employee should be paying the rent. So only you are eligible to claim, but not for the other property.
Okay. ATEE, just a moment. ATEE/EEA allowed for under construction property?
No, under construction property will not qualify for deduction, whether under 24B or 80EE or 80EEA. The construction should have been completed.
Okay. I think after full and final, this is from Sharon. After full and final settlement, if employee submitted POI, can we consider?
No, see, after full and final settlement, I'm not sure. I mean, whether your process, first of all, allows that, because once you're done with the full and final settlement, then basically that employee himself becomes inactive, right? So again, how can you consider and again revise everything? That's going to be a tedious task. So, I mean, it needs to be looked into, but there is no prohibition in the rules or in the law for that.
Okay. This question is from Dr. Mruthayanjaya. Can the employer change the payslip format, as we have others mentioned more and rent allowance is only 5,000 as it is lowest and can't save the tax and happen to pay more?
Can the employer change the payslip format? As we have others mentioned more, and rent allowance is only 5,000. The payslip has to be the format of the payslip. I think he is asking about the salary structure, whether he can give more HRA and then adjust the this one. So, yes, sir, these things need to be very sensitively need to be handled, because I mean, changing the prior month's payslips and all is not advisable. I mean, it is prohibited as per the labor laws. I mean, the Income Tax Act does not talk anything about it. However, when you look at the Shops and Establishment Act or any other labor laws, these need to be looked into as a very sensitive document. So this is not advisable.
Thank you. We'll just take one last question. This is to explain the difference between exemption and deduction.
Okay. So yeah, see, the exemption is basically comes, I mean, it does not form part of your total income at all. So HRA, for example, it is exempted. I mean, exemption. LTA is an exemption, so it will not get added to your total income. Whereas deduction is something which is allowed once you compute the total income. Salary, for example, basic salary is a part of the total income, whereas deduction towards LIC insurance comes after you arrive at the total income and then you give the deduction. So it is basically, I mean, one is not an income at all, but other is a deduction from the income which you have calculated. So that is the difference between these two.
Okay. Thank you so much for that, Mr. Amarnath, and thank you so much for this very insightful and comprehensive discussion today. The first part of it, of course, the presentation, there were a lot to take from that, and then again, this Q&A, it was not just for one individual asking their particular question, but with each person asking their question, it helps the other audience also to
Yes,
understand.
correct.
So
That's right.
thank you so much for making this
Thank you, Rakhi.
very
Thank you.
engaging and conversational today. And of course, thanks to our audience as well who joined us and made this a successful webinar. Thank you
Thank
so
you,
much. And
Rakhi. Thanks, greytHR. Yeah,
thank you so much, Mr. Amarnath. It's always a pleasure to host you.
same here.
Okay. So as we promised in the beginning, the webinar recording will be shared with all of you so you can watch it. We also have a Great Tribe community. It's a knowledge sharing platform. You can sign up to this community and have access to experts like Amarnath. And if you have any questions related to tax, compliance, HR in general, you can put your questions there and we'll be able to help you. Also, we are available on WhatsApp. So there's a QR code that you can see on your screen. For faster assistance, you can also connect with us on WhatsApp and we'll be happy to help you there. As I said in the beginning, webinar recording will be there. If there's any question also pending that you want to, connect with Mr. Amarnath later, you'll be able to do that. We will share his email ID with all of you. Also, before you log out, I just wanted to share the registration link of our upcoming webinar, which is going to be on PF, ESI, and gratuity regulations. It is planned on 9th January. So I have added the link in the chat. It's visible to all of you. You can quickly go onto that link and register now also. There will be another other emails that we'll send to you so that you don't miss out on this session. So thank you so much once again, everybody, for joining us and being very active and asking so many questions. It made this session definitely more interesting and insightful. Thank you, Mr. Amarnath, once again for your
Thank
time
you.
today.
Thank you.
Thank you so much. Have a great evening, everybody.